Recently, I've posted a number of videos about owner's distribution and equity and understanding that part of small business finances. But I know it can still be kind of a confusing topic, so I sent out to my newsletter list a request for your questions to just say, hey, does anybody have anything that I haven't covered yet that you would like me to cover in an upcoming video? So we gathered a few questions and I've lumped together a couple that were around the same topic, because my philosophy is if one person has a question, typically other people have the question too. Either they haven't figured out how to formulate their question, or they were scared to ask it because they thought it was silly, or they just didn't have time, frankly, to ask the question, but they do have it. So I like the questions and that's why I like you guys to put questions in the comment section below, because I do answer those. So these questions can help us come up with topics for ideas, and I think this one is a great one today. We're going to talk about owner's distributions and are they taxable? So if that sounds good, please stay tuned. And also, if you'd like to get on our newsletter list to have access to ask me those questions more directly and to get all the resources that we send out to our email list, you can go to claracfo.com/newsletter and you'll be given a form so that you can go ahead and get on the list. So I have to give a shout out to one of our viewers as well, because I recently posted a video on this very topic and then very quickly got a comment from one of our viewers saying, hey, actually, you've kind of missed this very important part about taxation and owner's distributions. And immediately I was like, oh no, you're exactly right. I did miss it. So I took down the video really quickly because my thing is I do not want to mislead anybody. And so if somebody watches something in one of my videos and says, hey, actually, that's not correct, as much as it kind of hurts as a content creator to be like, oh no, I didn't put out the right information, I am here to grow and learn. Okay. So just like you, I'm here to grow and learn. I want to do better, and I do not want to mislead you guys. So I know a lot of accountants watch this channel. So if you happen to know that I've said something that's maybe a little bit not true, or maybe a little bit questionable, I actually welcome those comments too. We're professionals, and I want to make sure that I'm leading people in the right direction. So yes, it's a little painful and it's a little vulnerable for me to tell that to you guys, that sometimes I'm not always right. Surprise, surprise, I'm human. But this has happened. We have over 300 videos on this channel, and I believe this has happened twice in the entire time that we've done this. So I really appreciate you guys. I really try to research and make sure that I give you the right information from the beginning. But I do also want to welcome that if you think that something that I'm saying is actually incorrect, that I welcome you to comment on it. So thank you to the viewer who said something, and we're going to talk about owner's distribution and taxation and make sure we get it right this time. All right. So if you aren't already subscribed to the channel, please, I invite you to subscribe because we're here to help you with your small business finances. All right. So we had a question from a viewer. I'm going to read this to you, and it is this. I have an LLC taxed as an S corporation. I unknowingly withdrew more money than the total profit in 2023. For example, we had $100,000 in revenue, $50,000 in expenses. So she had a profit of $50,000, but I withdrew $60,000. And for that $10,000 excess distribution, I understand that I have to pay capital gains tax. Is that correct? Is it going to be short-term or long-term capital gains? Okay, so that is the first question. And here's the second question that's not exactly the same, but it is related. Is it true that owner's compensation, not W-2, is not taxable? It's already taxed as income already. An accounting group told us this at a seminar. Of course, we still have to pay ourselves as managers and pay a salary in W-2, but not all of it. So I have been paying myself and taking a distribution to save on payroll taxes. The second person didn't give this explicitly, but my assumption is that the second person is also an LLC taxed as an S corporation, okay? Because they're talking about paying themselves on W-2 wages and also taking a draw. So we're gonna go with that assumption for the purposes of this video today. So both of these questions are talking about owner's distributions and how they are taxed. One of them is just questioning, are they taxed at all? And then one of them is questioning, is this excess distribution over profit being taxed? So we've got a couple different pieces here. Now, specifically, I wanna talk about a couple different things, and that is first, that this really depends on the entity type that you have. So if you are an LLC taxed as a sole proprietor, or you're just taxed as a sole proprietor, that and also a partnership and also an S corporation, those are what's called flow-through entities. And we've talked about those here on the channel before. The income from your business flows through to your personal tax return, and that gets reported, your profit gets reported, and you pay taxes on the profit. Now, corporations we're going to talk about in a little bit, okay? They're different. You get taxed at an entity level, and you can also be taxed on the personal level as well. But we're going to talk about that in a second. Put it on the shelf. Put it on the shelf back there. So I want to start first to say that the IRS mainly cares about and taxes profits from a business. Okay? Now, that's revenue minus expenses equals profits. That is the majority of when we're talking about taxing and what gets taxed in the business, that is the primary thing that gets taxed in a business. So that flow through entity, or if you're a corporation, you get an entity tax, you're going to have a tax if you have profit. Okay. Now, the distributions that we make as business owners are taking capital that the business has made, either from investments that have been made into the business or from the profits in the business, and that goes away from the business to the individual owner, okay? So we can call those owner's draws, or we can call them owner's distributions. Now, these draws are discretionary. Sometimes owners won't take draws at all, and then sometimes they have to take draws in order for it to be their compensation. So if you're a sole proprietor, that's how you pay yourself, is you take an owner's draw out of the business. And then sometimes if you're an S Corp, you'll take wages in a form of W-2, and then you might also supplement your income needs by also taking a draw as well. So these draws can be discretionary. So for the most part, the IRS doesn't really care on how much you're taking out of your business, but there is a caveat, okay? If you are a sole proprietor or taxed as a sole proprietor and you take a draw out of your business, it really doesn't matter. There's not a lot of scrutiny over it. So even if you made, in the case of our first example or our first question, if you made $100,000 minus your expenses and your profit was $50,000 and you took a $60,000 distribution, there's really no consequence for that if you're taxed as a sole proprietor, okay? So that's something to think about. Now, a partnership, you are never supposed to take distributions of in excess of what's considered your partnership basis, okay? Now, I'm not gonna go into calculating your basis, and especially not for a partnership in this video, because frankly, I don't do partnership taxes, and I am not the right person to be speaking on that. So I am going to put a video up here that's a very, very, very simple explanation of basis, which should be helpful for you guys to be able to take a look at that. And that can change over the years. So if you're watching this years from now, go and check your long-term capital gains tax rates, okay? And obviously the income brackets are going to change every single year. So this concept of basis in a business, very simply, and I'm not going to get into all the nitty-gritty of calculating your basis. You should talk to your CPA if you think you're not sure, have I exceeded my basis or not, is this, it's the equity section that we've been looking at in our business. Basically, there's going to be some adjustments here and there, but you're going to have whatever you've put into the business is recorded in your equity section. That's like your initial investment into the business. And then the profits and the retained earnings of the business is that continued investment. So the business has earned that. That's kind of part that increases your basis over time. And then your distributions decrease your basis. So what they're saying is, what the IRS says is, they say, basically anything that you take out of your business in excess to what has gone into it is kind of a gain, and they want to tax it. Okay, so it's like they are, just like you would sell a stock or something, they're going to look at that and say, okay, did you take a gain out of your business in excess of what the business has actually created in the world? So this can happen a lot if you have taken loans out in the business and you still are paying yourself. So this happened a lot during COVID, really, where there were businesses that were taking EIDL loans and still continuing to pay themselves like they had been before, and maybe they weren't making much money, and they might have gotten into negative equity situations where they were borrowing money, so they had cash, but they were actually not making enough money to increase their basis, and there's basis was going into the negative, and then they triggered tax liabilities. So there's some times where you can have a loss in your business and still have tax liabilities if you're taking all these distributions. Okay, so very specifically to answer our first person's question, let's review that. So she said that she was an LLC taxed as an S Corp. She made a profit of $50,000, but she took a distribution of $60,000. So this answer to this is it depends. What was her basis before? When you calculate basis, you say what's the beginning basis at the beginning of the year plus your profits, any other adjustments, minus your distributions, and then ending basis. So my response to her will be you need to go and look at your tax return, or you can look at your balance sheet, because the equity section is going to give you a good idea of, are you close to maybe being in negative basis territory? Because if you have negative equity, you probably have negative basis. And if you have positive equity, it's more likely you're going to have positive basis. But this will really be calculated on your tax return. So look at your last year's tax return, get an idea for what was your basis at the end of last year. If you were in that negative situation, you probably are going to trigger potential capital gains here. Now, for that amount, it kind of depends on your total financial picture, where you're going to be on that long-term capital gains amount. And remember, if you've owned your business for more than a year, long-term, under a year, short-term capital gains. Okay? So that answers that question. It's kind of, she needs to go back to her CPA and see what is my basis. Okay? And if it is that excess distribution, just the excess would be taxed. Now, I will say, there are ways to classify things differently. If maybe the distribution was actually truly more of a loan and the owner wants to pay it back, it can be documented as a loan instead and create loan documentation, have a repayment plan, have it clearly documented, and you could potentially reclassify some of that distribution into a loan instead if the owner wants to actually pay it back, okay? So there are ways that you can kind of get around some of the tax liability if, truly it was more of like, hey, I'm borrowing the money for a little bit and I'm going to give it back to the business, maybe as a one-time thing, needed to borrow money, that's kind of up to you and your CPA to talk about that. So let's go ahead and answer the second question too. So let's say a situation is that the company has plenty of basis. They've had many, many years of good profits, retained earnings are high, and there's no risk of triggering this negative basis situation with potential capital gains. Let's say that a business is making $1 million in profit, and that business is going to pay taxes on that $1 million. Okay, that's because the IRS is going to tax the profit. It doesn't really matter considering that we have positive basis, it doesn't really matter if that business owner decides to take zero money out of their business, if they decide to take $500,000 out of the business, or if they take 1.2 million out of the business. That doesn't actually matter for this business owner if they are in that positive basis territory, okay? And this is, I'm talking about that specifically for the S corporations, but this situation where this could happen in a partnership or an LLC or a S corp, where if the profits are there and the basis is fine, we do not have to worry about those distributions being taxed. Okay, really what the IRS is taxing is they are taxing the profit. Okay, so that's where they get their money, and they're going to pay. You're going to have to pay taxes regardless of if you take a distribution or not. So you need to think about that, and that's something that you can decide what's best for you. Okay, now let's talk about C corps for a second, because they are treated differently from a tax perspective. So corporations are not a pass-through entity. They are a taxable entity, and they are taxed at the company level. So when you look at a corporation, they're going to have their profits, and then they're going to have a tax expense there that's going to be 21%. So the profit in the business is taxed directly at 21%, okay? And that's current, again, with the year that this is being posted. So it's not going through to the owner's 1040, to their personal tax return, okay? Now, if the owner decides to take distributions that are not dividends, because dividends are treated differently, if the owner wants to take a draw, like an S corp owner or like an LLC owner, if they want to take a distribution like that, let's say they, needed $100,000 to renovate something in their home and the cash was there and they decided to pay a distribution. That distribution will be taxed to them at personal income levels, like at personal tax return levels. So not as a capital gain, it will be at, if they're taxed at a 35% tax bracket, that is what they will, so that $100,000 is going to have $35,000 gone just right off the bat. That'll be owed to the IRS. Okay. So this is actually an unfavorable tax situation. They call this double taxation because the entity gets taxed and then the individual gets taxed, and there's not really any tax benefit on either one. Like actually the owner, having to pay personal income taxes on that is, treated differently from the S Corp owners where we were talking about just the capital gains rates. Okay. So very different. Most companies are probably not going to be going that direction when they look at compensating their owners all around. They're probably not going to do what an S Corp does, where they're paying themselves in W-2 wages and also in distributions. They're probably going to more than likely pay most of the compensation out in W-2 wages. Okay, so going back to our second question is it true that owner's compensation, not W-2, is not taxable? It's already taxed as income before. Again, we're assuming that this person is probably an S corporation, and the answer is yes, but if owners are taking a draw, that draw may not be specifically taxable, unless we run into that basis issue that we talked about. If it is, if basis is less than 0, then you might trigger some taxation there, okay? These two questions have now been answered. I hope they clear things up. If you have any additional questions, please put them in the comment section below. And also make sure you get on our email list. We'd love to have you there. It's claracfo.com/newsletter. All right, thanks so much, everybody.